Question is, good evening, PCs. I want your opinion on this. What is the position of the tax laws on the remittance of withholding tax for individuals? The perspective I am asking this question relates to a situation where some individuals work for a particular oil servicing company whose workspace is in Delta State, but the head office is in Lagos, where all administration is centralized. So from this question, the head office administration head office is in Lagos, admin is centralized in Lagos, but these people work on field in Delta State. However, those guys do not want employment relationship, but opted for independent contractor relationship. All right. So in the form of a contract, meaning that payments to them for their services shall attract only withholding tax. So the issue is, where will the withholding tax deductions be remitted? This is because these guys are from states and are from other states, various states, and their residential address includes Lagos, Delta, Port Harcourt, Abuja, and the North. All right. So this question, even though it looks very simple, it's very tricky as well, and it's very and you may actually get it wrong if you don't take your time to actually understand the question. All right. So this person is asking with respect to people who have been engaged by an oil servicing company, right? So these people have been engaged. They've been engaged from different states across Nigeria. So, but then location the location where they're supposed to deliver the service or do the work they are being engaged for is in Delta State, right? So now these people are coming from Lagos. Sorry, is in okay, it's in Delta State. Yes, some people have been recruited from Lagos, from Delta, from Port Harcourt, from Abuja, and from the north. So now it's asking, of course, payments to these people. So these people have been engaged as contractors, independent contractors, meaning they are there. They do that. The relationship between them and the company stops as just a contract of supply of service. All right, so that's where it stops. So they are not full-time employees of the company, right? So all they will get is the contract sum that's been agreed for the services they are rendering. But they came from different states. So now the question is, where will withholding tax that is due on their invoices be remitted? There's a trap here, right? It's easy for somebody to fall into the trap of saying that, yeah, it depends on their state of residence, right? Yeah. So because you may actually think that you may actually say that since they are contractors and they are now and they now deliver service in Delta State, right? That we may need to check their where they reside and all of that. So, but the trick here is that these guys are delivering. They are under a contract of supply of service, right? So we need to check, even though their residential address is in Lagos, Delta, Port Harcourt, and the North, we still need to check, right, and be sure that those guys do not create any form of tax trigger in Delta State. So the thing is, even though they are not employees, right, and they are contractors, if once they reside in a state other than their other reside in any state more than 183 days, then some type of tax trigger comes up for them, right? So, but that is if they are under an employment contract. So, but for contractors who just go in to deliver service and come out, right, their primary residence still remains where they primarily reside, which in this case is Lagos, Delta, Port Harcourt, Abuja, and the North. So, this guys still goes back to their residential address. So maybe I guess they do work on field, maybe during the work days and weekends they go back, they retreat back to their state of residence. And I'm sure this service is not going, this contract is not going to last so long, right? So clearly, withholding tax is the only obligation that will be triggered for them. So this means that they cannot pay. They can only deduct withholding tax from payments made to them. All right. So this is a way um, of actually managing taxes for certain type of people whose employment contract would not typically exceed 183 days. So if somebody is going to do a terminal contract for you, say 3 month terminal contract or a 1 month terminal contract or a 2 months, right? that does not exceed 183 days, you can actually just employ them as a contractor rather than employ them as an employee, right? So to that extent, their tax liability will be limited to withholding tax, right? They won't be paying PAYE, right? Because because what they are doing is for their contract is for 3 months, right? So and they're not actually staying in that state for up to 183 days. So to that extent, it shouldn't be PAYE triggered for them. So you can manage their tax exposure this way and limit it to withholding tax. And the good thing is that the withholding tax rate for contract of service is now 2%, right? So when you compare 2% to actually subjecting their incomes to PAYE, which can be as high as 24%, depending on the amount or the quantum of the gross income that they earn, then you will see there's a lot of tax savings for these people, right? For the service providers to actually consider adopting withholding tax rate. So the next question will then be, if I'm deducting withholding tax, where then would I remit the withholding tax that I'm deducting, right, on these guys' invoices? Yeah, so it's the states where they reside, which is Lagos, Port Harcourt, in this instance, where all these people came from. That's the state that you remit their withholding tax. So this is not different from what you would do if you have engaged, say, an auditor, a tax consultant, a lawyer, right? If you have engaged all these people to deliver services to you should actually remit their withholding tax to the state where they reside, right? So, for instance, if I'm in Abuja now and I'm engaging an auditor and the partner is resident in Lagos, right? When I'm going to pay the withholding tax on that auditor's invoice, I'm going to deduct it and remit it to Lagos State because that's where he resides and not to FCT where the service was provided. All right. I hope that is quite clear. So that's the position of the tax law actually, and this is the type of conversations we have on my group, right? So if you have any questions, please, or clarifications, you can drop in the chat. I would provide further clarifications. I know I've said a lot of things. You might not get me clearly. So please just drop in the comments. Let me know anything you want me to clarify or provide more information on, and I would go back and give you that more information. All right. So yeah, so that's on that question. If you also have a question, a different question entirely, different from what we are discussing, you can also drop it in the comments and we will take it and dissect it together. All right. So yeah. So I would go into the second question now. All right. So the second question is a bit more tricky. So this is on the transfer pricing issue actually, right? So there are two related companies. Say company A helps company B for collections and payments in support of the company's operation. All the collections are recorded as payables and receivables as the case may be in the books of company A. However, company A does not have any business belonging to her in a particular year, meaning that all the turnover in such year relates to only collections and payments made on behalf of company B, on behalf of company A rather, sorry. Okay. So an issue is that the payment collection agreement did not include payment for the services rendered, meaning that the services are carried out for free. Is there an element of transfer pricing disclosure returns required for both parties? Should there be payment for services rendered by company B to company A? Does it change anything? Okay, all right. So let me just break it down for those who may not quite understand what this is. So this is a typical transfer pricing issue, quite common in Nigeria, right? With fairly when you have companies, related companies that transact business with one another. So what we have here is a classical case of a company facilitating collections and payments for another company. So company A in this instance facilitates collection and payment for company B. So I would imagine that company A is a bigger company or maybe the parent, right? So he has the financial muscle and is able to settle certain transactions, right? Which company B may not be able to, or company A may be more liquid, while company B is less liquid. So in this instance, company A assists company B to pay for certain transactions, say for instance importation of equipment, importation of the items of inventory. Company A makes payment, right? And then on behalf of company B, all right? So now the question is there an element of transfer pricing? So typically, when you look at transfer pricing actually tries to ensure that transactions between the third party are done at arm's length, right? And it ensures that the prices are proper. So it ensures proper pricing. So when pricing is not done properly, the transfer pricing rules actually requires adjustment to recognize and to correct the pricing and ensure that prices are correct, right? So what then happens is when you have to, so this what is happening here is actually a service. It's not, it's actually a service, right? Because you cannot be helping somebody to pay and collect without any income, because what you are doing is actually using your own funds to finance the operation of the second company. So to that extent, there's supposed to be cost attributed to the service being provided by company A, in this case the parent company, right, to the smaller company. So now, how do you determine that pricing? That is where transfer pricing comes in, because they need to, this then requires that you carry out some kind of specialized adjustment and specialized review, right, and benchmarking to then determine what should be the proper pricing for that transaction, the facilitation of collection and payment, right? So once that is done, of course, the transfer pricing experts they know how to do all of that. So they have tools actually that they use for benchmarking. They have tools they use to benchmark. So when they benchmark, what they try to do is to compare what other companies, right, in the same industry with similar transaction, right, what they charge for that type of service, right? So they try to check what they charge and they ensure that the pricing they are setting for the company A in this instance is within a reasonable range. So it's reasonable, it's not too far from what is obtainable in the industry, and it's within a reasonable range. Because why they do this is because even during audits, the same TFIS will do, the tax authority will do the same thing. They will do the same review, the same research to ensure that pricing are within reasonable limits. And when pricing is outside the reasonable limit, especially when it is high or low, it can be adjusted for. So when the pricing is too low, right, it means that you're actually trying to reduce the cost, right, for yourself. And then what that means is that you are going to be, when you reduce your cost, when you reduce cost for the parent company is going to report higher profits, right? So when the parent company reports higher profits, and the parent company is not in a tax-paying jurisdiction, for instance, the parent company is in a free trade zone or is under a pioneer tax holiday, you have successfully shifted profit to a lesser, successfully shifted profit to a lesser paying company, right? So what you are trying to do is reducing the amount of taxes that should be deductible, right, in that transaction. So and of course, because that will also affect withholding tax, right? That should be deducted and paid on that transaction. So when the price is too high as well, we are also trying to reduce profits and or reduce profit of one of the two companies, and so that way, what we must ensure is that the price is within the reasonable range. When it's within the range, then there won't be any issue. All right. So is there going to be, so the question now, back to the question, is there an element of transfer pricing disclosure and returns required? Yes, of course, is an element of transfer pricing disclosure and returns required for both parties. And should there be payment for the services rendered by company A to company B? Yes, there should actually be payment for the services rendered between both companies. All right. Okay. So I'm checking through the chat now. I want to see if you have comments. Please drop your comments and reactions to what we have been discussing so far, and so that to get the session going. So those are two questions from my community, right? So please, if you have questions, you can drop them in here, right? And I will take them. So as a follow-up to this second question that we just discussed, I also want to paint another scenario where company A, the parent company, right, imports goods right? Imports goods, for instance, and then goes ahead to sell the goods to. So of course, company A imports goods for resale in Nigeria, right? That's its ordinary course of business. Imports items for resale in Nigeria, but then it has a subsidiary company B. It sells to its subsidiary company B, and it also sells to the general public, right? So, so now is there going to be transfer pricing issues, right? When he's selling to when he sells to his related party, is there going to be transfer pricing issues? So, or what are the considerations? What should the company watch out for to ensure that there is no transfer pricing exposure? So, I think I will take the second question. So, the second one, that what are the things the company should actually watch out for to ensure that there is no transfer pricing exposure? So, the very important thing to watch out for is to ensure that when you buy and resell, you sell to your subsidiary at the same amount that you sell to third parties, right? So if you can demonstrate that as a company you have sold the same to the general public at the same amount or third party the same amount as you sell to your subsidiary, then there is no transfer pricing issue. Then that it means that transaction is at arm's length because you've also demonstrated that that price is accepted or acceptable to a willing third party, right? So the willing third party pays the same amount, so my subsidiary also pays the same amount, then clearly there's no transfer pricing issue. And I won't run into any risk of transfer pricing adjustments during tax audit. But in a situation where I sell to my subsidiary at a lower price compared to what I sell to third parties as willing buyers, right? Then I would be exposing myself to transfer pricing risk, and transfer pricing adjustments would kick in during audits. So I just want to understand the dynamics and how a simple change, right, in the transactions can change the whole thing and flip the implication for businesses. So these things are very tricky, and it's good that we pay attention to the details so that we don't miss any important points that would then change dynamics and throw the company into issues, or your company into issues, or your clients into issues. All right. So we can go on and on, right, discussing these transfer pricing issues. There are different scenarios, different things that can come up, right? You can also give loan to your subsidiary, right? So what is important is that when you are giving loan to a subsidiary, you should ensure that you are actually charging interest that is within reasonable limits. So now, of course, you can't charge your subsidiary the same rate that commercial banks will charge, right? You cannot charge a subsidiary, say 30% for instance, or 30% interest rate. You actually want to do lower. So once you do lower, you are fine, as in because it's public knowledge. You can easily demonstrate that the interest rate you have charged is within reasonable limits, especially because it's not even up to the commercial rate obtainable in the country, right? So for interest, it's actually um, and easy conversations to have. But for other type of transactions, it's always very difficult. For royalties, for royalty payment especially, right? That's even more complicated. I can't even be discussing that, right? I'm not a transfer pricing expert, so I wouldn't want to go into royalty payments. So, but for other transactions, buying and selling, payment facilitation, shared cost is actually something that um, you should pay attention to. Now, talking about shared cost, you for shared cost. So, if for instance you occupy an office building and you have more than one companies or more than one businesses using that office space, office building, then you need to do the proper allocation of the cost, right? You need to do the proper allocation of the cost. So you can use floor space occupied as a basis of allocation, right? So if you can determine for sure the floor space occupied by each of the companies, then you can use that as a basis for allocation. If you can also determine for sure, or if you don't want to use that, you are not certain about the floor size, then maybe you can use the number of employees from each of the company as a basis, right? So typically you just need to find a reasonable basis to do allocation of those costs, right? And then test it using transfer pricing methods available to ascertain if what you have done is within reasonable limits acceptable by tax authorities. All right. So going to 2026, tax authority will actually become more stricter. They are going to enforce the tax laws a lot more, and we are going to see a lot of audits coming up. And you can be sure that this is one of the areas that the tax authorities will be looking into, right? Especially for companies that are within a group. All right. So yeah. So thank you. Let me check. Okay. So okay, Grace, you are welcome. You're welcome, Grace. So if you are here, you can also just say hi so that I can shout out to you and welcome you to the stream. All right. So Grace, you're welcome. You're welcome. Thank you for always turning up, for always showing up. Yeah, you're welcome. All right. So in the absence of more questions, I will just quickly go to my community again. I have loads and loads of questions, right, that we can continue to discuss, right? So, yeah, so the common questions I get every day is about whether to set up a business name or a limited liability company. At some point, I thought that we have exhausted that question and we have dissected and settled that question, but I don't think that's the case because I keep getting that question over and over and over, and people keep asking, should I set up a business name or should I set up a limited liability company? Of course, for those who want to set up business names, um, what I always say is that are you still a micro business? If you are not a micro business, then you should actually set up a limited liability company. So for some people, if they also look at their scale and the size of what they do, even though they are not micro, but they are very small, right? They are still small. So for them, they may actually still choose to remain business name because becoming a limited liability company comes with other obligations. So there are obligations around statutory audits, right? You need to get an auditor to actually prepare your financial statement, right? So there are other compliance requirements that follows being a limited liability company. So all of those may actually just kill those type of businesses. And of course, for businesses in the informal sector who do not require any form of formal documentation, or they don't even need to have a legal entity. All of those things do not necessarily affect them. Then maybe they can remain as business names. So, but for a large majority of business owners who are doing good numbers, of course, upgrading to limited liability company would actually be more beneficial. Then people have also painted a different scenario. That the scenario is that okay, the threshold is 100 million for exemption, right? Okay. So what of if I'm already making more than 100 million turnover, and I'm currently a business name. I'm already making more than 100 million turnover. So advise me, should I still upgrade to limited liability company? Because the reason for upgrading that is being preached is that exemption. So now I can't even get the exemption. I'm a business name. I can't get that exemption. So should I upgrade? What I've done for this type of people is to actually run a simulation, right? I've run a simulation of what the tax exposure would be if they remain as business name or if they upgrade to limited liability company. All right. So in the real sense, for a business name who is already doing more than 100 million turnover and will not get CIT exemption, it is actually more tax efficient to remain as a business name. Let me explain why to you. So for companies above 100, for businesses making above 100 million, right? When they are limited liability company, they will pay tax at 30%. They will pay development levy at 4%, right? But if they remain as a business name and making their 100 million, they will pay tax at they will pay tax. Their tax will be determined based on the graduated table. So and the highest rate is 25%, right, for amounts above 50 million. So clearly they are paying lesser tax. They are paying lesser tax as a business name with over 100 million naira turnover they are paying lesser tax. So in the real sense, it's better for them to remain business name because they won't even get that exemption anyways, right? So, but now, yeah, let me just sound a note of warning. So, yes, as a business name, if you are doing this, then you need to be sure that because there are other things to also consider. Of course, you need to consider the legal entity concept. That's the protection you get when you become a limited liability company. You're able to separate your business from you, the business risk. You're able to separate it from yourself, right? So we need to consider that as well. We need to consider the fact that when the company is being sued, when your business is being sued, if you're a business name, it is you that is being sued. So, but if it's a limited liability company, your company is sued, you are different from your company. And in the case of bankruptcy, the company will fully absorb all the impact of bankruptcy, all the assets of the company will recover to settle the debt, the bad debt. So, but when you're a business name, that would not happen. Your personal property will be taken to settle business debt. So, very important that we consider that. So in all of this, you need to then do so what we look at now take a balance. So sorry, to now take a balanced position, right? It may then be good that you actually upgrade, right? You have to be in a balanced position so that you are not unnecessarily exposing yourself, right? Even though you don't want, even though you are losing so much in taxes, right? That you are paying because you are now a limited liability company, but you would actually be saving yourself from a whole lot of other non-financial risk, right? This is actually something that dropped in my mind, and I know some people will be in this situation. They would actually be already making over 100 million, but they are considering whether they should upgrade or not, knowing that when they upgrade, they won't still get that exemption. And when they upgrade, they will be paying taxes at higher rates, right? And but what I would say to this type of people is that consider balance, right? There needs to be a balance. So you don't want to expose yourself unnecessarily. So you'll be playing to playing to the extreme, right? When you decide to remain as a business name because you think you're already doing over 100 million and you won't get any exemption under the company's income tax. So it's actually better to upgrade and get protection. So because it's a business you are running and your business needs to be sustainable, right? So you get that balance, get that protection that the limited liability company status he provides, and then whatever taxes you are paying, you will just know that yes, that cost you are paying is actually an opportunity cost, right? And it's an investment into protecting yourself, protecting the business, and maintaining and reducing potential risks that may actually have impact on you directly and your private assets, right? So I think that has addressed that. And if you have any, you can drop your comments, observations, and then I would take them. All right. So yeah, so I think that's I've been able to discuss that. I hope uh, I hope my followers will get to see this and they would hear the answer to the question. And I'm sure I hope this will also provide clarity to other people who may still have this type of question on their mind, right? So okay, so let me pick another question. All right, so uh, another question that we can take another question from my community, and then we can dissect them and provide answers to them. All right. So before we go to that, I'm sure we are all, it's less than 30 days to the commencement of the new Nigerian Tax Act. It's actually going to bring in a lot of changes, right? And I hope we are all geared, we are all ready for this implementation. And for individuals who are yet to obtain their TIN, I would advise that you go ahead to obtain your TIN, right? So it's actually easy. So for people in Lagos who have LRS ID already, I know you already have your TIN. If you check your e-tax portal, you will find your TIN there as well, right? So, but then you can also still go to the JTB website to register for a TIN. It's actually seamless, very easy, and you'll be able to get it on time, delivered in your email actually. So come January 1st, nobody should actually be caught unawares. Nobody should be in a situation where they do not have TIN. So we don't know to what extent the implementation. We don't know what I said the banks would actually go ahead to implement um, the TIN and compliance. But I know that a number of banks have sent out emails, right, to their customers to come forward to submit their TIN. So I think it's something you can actually just walk to your bank and supply to them by yourself, right? Just volunteer it to them so you can have it, and then you don't have any issues coming up next year. All right. So yeah, so I think you should something that we should all be aware of. Okay, so there's a question here. Okay, so I think I should take this question, right? So this question says the new tax law introduced progressive tax rates from 0% up to 25% for individuals. Does this new brackets really reduce the personal income tax of middle income earners? Okay, yes. So I think I've discussed this before, so but I'll just take it again for emphasis. Yes, so the new tax law actually provides now a graduated table for computing tax liability. So the first 800,000 will be taxed at 0%, and then up that way, and then you have 50 million as an income above 50 million being taxed at 25%. So the question now is that for middle income earners, will will their taxes actually reduce? Yeah, and the answer to this is yes, their taxes will reduce. So in fact, if you check the calculator that is available online, there are so many calculators online. I also designed a template which I've also shared here publicly for everybody's benefit, right? So if you use any of these calculators, you would find out that the tax liabilities of middle income earners would actually reduce. So what I did in my own simulation is to actually impute figures, different salary figures, right, of individuals. So I started with, of course, we all know that 800,000 people earning net income or gross income of 1.2 million, net income of 800 or gross income of 1.2 million. We all know that they are exempted from tax because they are going to be taxed at 0%, right? So those ones are exempted. Before it was only people earning 360,000, right? Net income. That's 30,000 per month as a net income that were exempted from tax. So but now we have more people being exempt from tax because the threshold, the band has been expanded and increased. All right. So those guys are going to be exempted from tax. Therefore, people with gross income from 1.2 million to 20 million, this group of people, these are the middle income earners, they're actually going to pay less tax, right? Next year, they're going to pay next tax. So so I know a lot of yeah. So when I discussed with some people and I ran their numbers with them, and they saw that they were going to pay less tax. Of course, they were happy, right? So that is what is going to happen. So middle income earners will be paying lower tax. Some people as much as 10,000 naira less every month. Some 15. So depending on the your own circumstance, so it actually varies for different people because we all have different levels of we all have different variables. For instance, somebody may be doing NHF contribution and you are not doing. That's one. Another person may be doing interest mortgage interest, right? So for those people that have additional deductions like that, insurance premium and all of that, they would actually be paying a lot more. They would actually be getting a lot more deduction, right? They will getting more deduction, more tax deduction, right? And that will be to their benefit. All right. So yeah. So another thing I want to touch on is the rent relief, the claim of rent relief. So, um, I've actually worked with a client who who in his own company they have almost 1,000 employees. So, her question was, for sure, we have 1,000 employees. Am I going to be asking for contract of from 1,000 people, employment contract of rent agreement from 1,000 people, and I will now sit down and be reviewing the rent agreement and be reviewing their receipts to determine the rent amount and all of that. And even if there's cutoff, for instance, you can have rent increase mid-year or rent increase during the year. So who is going to be doing all that work? Sit down and be doing those calculations to determine what the appropriate rent relief is. So, but I said, of course, somebody has to do it. So somebody has to do it. So that's the work that needs to be done. So, but of course, you can also help yourself, right? You can also do um, Google Forms or create a platform where people can actually upload their rent receipt, and before uploading it, they also put in the information, right, that you need. So when they put in the information like the effective date of their rent, from when does it run, and up to when, and the amount for each cycle of the rent, so they can put it in that Google form, right? So you can know for sure the rent period and the applicable rent amounts during the rent period. Then you can also make them select whether they paid the rent solely or they contributed to the rent. For instance, if somebody is married, maybe the husband and wife contributed towards the rent, then they can indicate what amount they paid, what amount the other party paid, or if it's a shared apartment, then you can indicate how much they paid and how much the other party paid. The reason is because it's only the actual rent paid that will be deducted, right? So it's the actual rent paid by the employee that would actually be deducted or be allowed as rent relief for the employee. So yeah, so of course, I don't. Nobody should be looking. Nobody should accept physical rent agreement or physical rent receipt. That's a lot of paperwork, and I bet you when you need those documents, you may not find them, right? You may not find them again. And even in fact, if you collect it and you want to scan yourself to then upload and keep the soft copy, that's too much work for you. Rather, let everybody scan their rent agreement, let them scan their receipts and sent to you, so you can have a folder where they upload it, and then you have another form where they fill in the information that you need. So when you have the information at a glance, right, for all your employees, you can then do random check, right, to random check to confirm that the informations are correct. So, but please be careful. It's only people that paid actual rent that will get relief, and people can only get relief for the amount that they pay, right? So that's the first step. Confirm the amount they paid, the actual amount they paid. That's the amount that should be considered when determining their rent relief. All right. So the second step, after you have gotten the documents, the agreement, and the receipt, and you know for sure the names of all the people that have paid rent. So please, it's not all your employees that would get this relief, right? So you have employees who are still living with their parents and they're not paying any rent, or they are living in their own their a self-owned property, that is the property they bought or that they built or that they inherited, whatever. Once they don't pay rent, they would not benefit from this. So there should also be a field for people to select. I stay in a self-owned apartment, or so that they are not considered for rent relief. All right. So when you get all of this together, you can then run your payrolls, you can run your figures and determine the rent relief. Yeah. So the funny thing about this is that the relief people are getting is capped at 500,000, and we still need to go through all this stress, right? So, but then it is the law, and we have to follow it. So, so the cap is 500,000. That's the highest relief anybody would get, and it means that the only people that will get 500,000 without losing any value, right? They are the people that are paying rent of 2.5 million. So if you are paying rent of 2.5 million, it means you are going to get your exact relief, which is 20% of your annual rent paid. So you will get your exact relief. So, but once you are paying rent of 5 million, 3 million, 4 million, it means you're not getting your full, you're not getting your leave is capped at 500,000 and the excess amount is lost. So it's yeah, so you are, it means you are paying for you are paying, you're not getting relief for the additional any additional rent above 2.5 million. But for those that pay below 2.5, of course, rent is capped at 20% of their annual rent. Annual rent. So if for instance you pay 2 million naira for rent or you pay 1 million naira for rent, then your rent relief is capped at 20% of 1 million, which will be 200,000. So you only get 200,000 naira rent relief. All right. So that is that is the position of the tax law, and I believe it's quite clear, even though it's tedious. So, but that's why it's good that we plan ahead. So this is the time to start doing the right sensitization for employees so that they are also aware of what they need to provide, right, come January 1st. So start talking to your employees, start preparing their minds so that they begin to have the right conversations with their landlords, right, so that and their lawyers on their property lawyer, whoever it is they are dealing with, right, so that they give them the right documentations, the rent agreement, and the actual rent receipts, right? So because of course all of this becomes very important from 1st January 2026. So beyond this, by now, all HR should already have their templates or their platforms already adjusted for the new law, for the upcoming law. You already have your templates already adjusted, your systems, your payroll systems already set up for the changes coming up in 1st January 2026. Yes, it looks small, so but depending on the numbers of people you have and how your payroll is being run, and whether it is centrally run or decentralized and all of that, it brings in a lot of complication, right? So it's important to start early and start putting your house in order. So you'll be surprised how difficult it is for people to actually show you an evidence of rent they paid. So it's important that you start telling them now so that to prepare their mind so they can start putting together all the documents that you will need to actually prepare your payroll come January 1st, 2026. And of course, January is here, it's very short. Before you know it, the whole month is over and you need to pay PAYE for January, latest by 10th of February. So please get on this quickly and ensure that you initiate the process quickly to get people to provide necessary information that you need. All right. So please, let me know if you have comments or questions. You can drop them in the chat box and I would take them. All right. So we've been here. We spent 47 minutes here together. Yeah. So I truly appreciate your time. I appreciate you staying this long in this live stream, and of course, we do this every week, right? So we are not stopping. We are not relenting. We will continue to do this every week. This will continue to run, right? To um, every week. Okay, somebody has a question. Okay, Abdurrahman, can we use the rent evidence as loophole instead of asking evidence if the rent is shared or not? Okay, I think I understand what you are saying. So you are saying that can we just instead of asking employees whether the rent is shared, can we just take advantage of it and just tell them to and just claim the full amount of rent, right? That was paid, not that they have paid, that was paid on the accommodation they live in. Of course, this will also be even for people staying with their parents. Can we just allow them take the relief for the rent that was even paid on the apartment they live in, whether or not they paid the rent? Okay, yeah. So I've had this question a lot, right? So the thing is, during audits, so the truth is that during audits, the tax authorities would actually ask for evidence. You know how the states authorities do when they do their audits, right? Even for pension payments, they ask for evidence of payment of pension. They ask for employee evidence of employee contribution. They request for it, right? In the past. So now rent is now another one that they begin to ask for, and you can be sure that they would actually ask, right? They will actually ask for the rent receipt, evidence of payment, and when they ask for the evidence of payment, If the employees are able to provide an evidence that show that they actually paid the full rent, then it's fine, right? Then of course you have no reason to object to it, because because that's an evidence. So if they can substantiate that they paid the full rent, why not? It's okay. So, but the truth is, we don't know the extent to which the tax authorities will go. So, for some, because now we have over 36 states and the FCT, so we know that we in practice we know the ones that are very aggressive, right? We know the ones that are very detailed and go and dig deep to the letter to confirm to confirm tax positions. So for those ones, you need to be very careful, right, when dealing with them. So if you know that most of your employees reside in those states where the authorities are very strict and they are very detailed, then you also need to prepare. You also need to go to them with that level of details. You also need to then be prepared and adequate and another level of details to defend yourself when you get to them. So, but for some other states, you may get away with it because, of course, in fact, some of them don't even do audits, right? So some states don't even care about IGR. That's the truth, right? In this present Nigeria, some states don't care about IGR. So, but some states actually care as in, and they look after and they chase hard for tax payments. So when you're dealing with those states, you need to be very careful so that you don't necessarily expose your company and yourself to additional tax liabilities. And the reason I don't like tax audit adjustments or additional liabilities is because it comes with penalty and interest, right? It comes with penalty and interest, and the penalty is huge. Now it's a penalty of 40%. 40% for any amount of tax that you are supposed to pay that you have not paid is a penalty of 40%. So, and this is going to be gangster as I'm going forward. So I don't want I do so I would rather say avoid that penalty of 40%, right? Be in a position where auditors come, they are unable to establish any additional liability, right? And the good thing about that is that if they come in the first year, they do all their adjustment, all their audits, no liability. They come second year, they do it again, no liability. The third year, they will not bother coming. And this is a life experience that I have personally experienced working for some companies. So I consulted for there's this particular company I consulted for. It's a Japanese company actually in Lagos. The company is owned by a Japanese. It's a Japanese company. Sorry, it's a Japanese owned by a Japanese corporation. They have a representative office in Lagos. Of course, the operations of the company is very small. It's very lean. Maybe maximum is 10 staff, right? In any particular year, they don't have more than 10 staff. Minimal operations, just a rep office, just for marketing, right? They just what they do is establish contracts with customers in Nigeria and then send to the Japan corporation to come and execute the contract. So no complex operations. So the payroll is very small, 10 employees. The company remits taxes fully compliant. No for contractors for vendor transactions, auditors, tax consulting fees. They know all those things. Very handy. They deduct with any tax, remit it appropriately, and that's all. First year, auditors came, tax auditors came, LIRS, even FIRS too came. They did all their reviews, no additional liability. Second year, no additional liability. The funny thing is that first year, no liability, they didn't give us a report. There was no need giving all these reports, right? Because there's nothing they were going to write in the report. Second year, same thing. Did our field work, went back, no audit report, nothing to put in the report, no adjustment. Third year, they did not come again. They did not come for audit again, third year. Till I left that particular firm I was working, that company is a client that I was consulting for. No audit again. They never came back for audit. Both, especially FIRS, never came back. LIS will still write. So, but of course, when they write and we object, they close it and they just move on. All right. So that's a position I like to be in as a consultant and as a taxpayer. I like to be in that position where the authorities will just walk away and they will not even bother to come back again, right? So Yeah, there's a question here. What is the threshold from withholding tax for business name and LLC? Threshold for withholding tax. I don't understand that. What is the threshold from withholding tax for both business name? Are you talking about the 2 million naira transaction um, exemption? So okay, so let me just okay. So this one actually applies to small companies, right? Um, So once the transaction is not up to 2 million naira in a particular month, as a small company, you are exempted from deducting withholding tax from vendor transactions. I hope that is what you are referring to. Like, that's what I can understand from your question. This is not clear. I hope that's what you are referring to, and I hope I've been able to answer your question. So yeah, so it's for small companies, right? So they are exempted from deducting withholding tax from vendor transactions. All right. So yeah. So that's it. Okay. Yeah. So thank you. So thank you, Anyola. Thanks for that question, and I hope I've answered your question clearly. So please let me know. You can you can drop a comment if you need more clarification or you require more explanation. Okay. Yeah. So that's it. So that's it. I think okay. It's already 5 minutes to 8. Wow, wow. That's good. I think we can call it a day at this point. That's 1 hour already gone down. Thank you all for staying. Thanks for staying with me this evening. I truly appreciate your time. For all those that have been here for the past 1 hour, I truly appreciate coming in here to join the session today. And thanks for the contributions as well. Yeah, thank you for the contribution. Okay, Daniel, thank you. Oh, Daniel, again, wow. Nice. Thanks for always coming here. Thanks for always showing up. Truly appreciate your presence. Yeah, thank you for always showing up. All right, so if you are yet to join my community, Daniel is a member of my community. He knows what goes down there. If you are yet to join my community, please, I would advise that you reach out to me. You can reach out to me via email so that I can add you to my community, and you can also be part of us. You can also um, benefit from what we discuss in the group. This rent issue is still going to be a challenge for us. So we are planning to use 500K flat for everyone. Yeah, yeah. So, so the thing is, yes, being practical, right? That is what I've spoken with. At least in the past 3 months, I've spoken with almost 20 HR executives, right? Everybody is saying they are going to use 500,000 for everybody, that they will not go through that stress of asking for agreements, receipts, and be tracking anything. That is what everybody is saying, right? So for convenience. So, but then I understand the place of convenience, right? But I'm trying to also I'm trying to now I'm not trying to backtrack and look at what we were doing in 2011 when I started working, 2011, 2012, 2013. There was this personal relief allowance then that the law provided for. So the allowance was, I think, 25,000 per dependent, right? 25,000 per dependent. That is your children allowance. You're supposed to get 25,000 per child. So when you multiply it, is it 25,000 or 5,000? I can't remember now. When you multiply it, you get 100 or something like that. So back then, everybody used to get the 4 children dependent allowance. Everybody, even single people, they get the relief for 4 children allowance. Everybody just takes it, children allowance straight. Then, so is this going to be a recantation of the children allowance we used to have? This go the same way. Will everybody just take 500,000 flat and we move on? So that's we will get to know that when implementation starts, right? So, but again, let us also be cautious. Let's be careful. Um, the tax authorities are actually stricter now, and with penalties also, higher penalties, 40%. It's a lot of monies, right, that we can save. So as much as possible, if we can um, arrive at a position that is close to reality. So for instance, you may decide to say, okay, for this category of employees, I know they cannot pay 2.5 million naira rent, right? So for instance, your drivers, okay, of course, they will be exempted anyways if they are not earning below 70,000. So, but for people that you know that they cannot pay, their rent should be maybe 800,000, 1 million, then you can actually just, for those category of employees, you can limit their own to say 1 million, right? Another group, 1.5, another group, 2 million, then before you now do 5.5 for others, right? So just to be on the safe side and you don't unnecessarily expose yourself, right, to excessive tax. So it's something you can work around, right? So at the end of the day, we are running businesses and time is also important. Time is money. So if you think the time to gather rent, documents, and all that is too much, and you just rather settle for whatever tax consequences or that comes up, then it's fine. So it's a decision that you can make as a business, right? And stay with, right? And then of course, so it's something that you can actually decide and work with. So, but to ensure that you don't have any exposure, just get actual rent receipts. Okay. Thank you so much. Thank you very much. Classifying employees into different bands is a good one. Thank you, sir. Yes, I think we should just categorize employees into different bands. So that will bring it close to reality, right? So and then they are not unnecessarily exposed even if the reality is different from what you have done. So I think it's the best that I think that's the best approach to actually adopt, right? So that you don't so that at least you are complying and then you are not wasting so much time complying. All right. So thank you very much. Thank you for the contributions today. I really appreciate the time we spent together this evening. And as you know, we'll be having this session again next week. So next week's another time. Next week, Sunday, same time, 7 p.m. We will be having this conversation again. And please make it a date with us again next week. And thank you very much for your time today. Thank you for staying here. And I do wish you a great week ahead. Thank you, everyone. Thank you. All right. Have a good night rest.